Merlin Entertainments runs every major British theme park: Alton Towers, Thorpe Park, Chessington and Legoland Windsor. For 35 years they have had no serious competition. That is about to change. In August 2025, S&P Global downgraded Merlin to CCC+, 5 notches above default. Weeks later, Moody's downgraded them again, this time to TUCOL1. Junk. Their verdict was that Merlin's assets are tired and less relevant, and Universal Studios UK breaks ground in Bedford. This is why Merlin is terrified, and it has nothing to do with the rides. S&P Global's August 2025 downgrade placed Merlin Entertainments at CCC+, 5 notches above default. The agency report described the company's capital structure as unsustainable and warned that Merlin could run low on cash in 2026 unless conditions improve. Moody's followed in October, assigning a Caa1 rating and calling Merlin's assets tired and less relevant. Both agencies placed Merlin deep in junk territory, a zone where borrowers are seen as high risk and reliant on favourable market conditions just to meet their obligations. In practical terms, a CCC+ or Caa1 rating signals to the market that lenders now expect a real possibility of default. Borrowing costs rise sharply, refinancing becomes more difficult, and access to new capital is restricted. The agency's language is direct. S&P highlights persistent high cash burn and a risk of liquidity shortfall in the near term. Moody's points to challenging trading conditions and a business whose appeal is fading in the eyes of consumers. Helen Rodriguez, head of special situations at Credit Sites, told the Financial Times that profitability is being gnawed away. She described Merlin's growth strategy as scattergun over expansion, a pattern of spreading investment too thin, with little evidence of sustainable returns. These are not isolated opinions but reflect a consensus among independent analysts and rating agencies. The verdict from outside experts is clear. Merlin is now viewed as a high-risk borrower, facing elevated refinancing costs and diminished flexibility. These ratings shape how every lender, bondholder and investor will price risk for the company ahead of the £630 million maturity due in 2027. Merlin's refinancing problem is not theoretical. The company faces a hard deadline. £630 million in senior unsecured notes reach legal maturity on November 15, 2027. These notes, originally issued when Merlin's credit was still considered investment grade, now sit deep in junk territory. The terms are set by a formal indenture, with City Trust Services as trustee. A key clause restricts how Merlin can use proceeds from asset disposals, including a cap of £35 million that can be applied directly to repaying these notes. The rest cannot be used for this purpose, regardless of how many assets are sold. After the S&P and Moody's downgrades in 2025, the market's reaction was immediate. Bloomberg tracked the notes' price falling to 86 cents on the pound, reflecting a sharp jump in perceived risk. Yields rose to around 9%, more than double the original coupon. Daily trading volumes dropped and the bid-ask spread widened, signalling that liquidity had dried up. Investors were no longer willing to hold Merlin's debt without a substantial risk premium. The sale of 29 Lego Discovery Centres in 2025 brought in roughly £200 million, but the indenture allows only a small fraction, £35 million, to be directed toward the 2027 notes. The rest is ring-fenced, limiting Merlin's ability to chip away at the looming maturity. Options for refinancing are narrow. Issuing new notes would lock in high interest costs. Amending the existing terms would require creditor consensus and likely a premium. An equity injection would dilute existing shareholders and is far from guaranteed in current market conditions. Each pathway is expensive and none are straightforward. The clock on the 2027 maturity is now running, with limited room for manoeuvre. Merlin Entertainments' 2025 financials present a company under considerable strain. The group posted an operating loss of £58 million and a net loss of £406 million for the year. Total assets stood at £7.4 billion, but equity had fallen to £885 million, a negative movement that underscores warnings from S&P and Moody's about an unsustainable capital structure and tired and less relevant assets. These are not isolated metrics. They reflect a business model struggling to generate sufficient returns even before accounting for the cost of capital. On the other side of the ledger, Comcast's theme park division reported a 19% year-on-year revenue increase in the third quarter of 2025. This growth was driven by the opening of Epic Universe in Orlando and higher per capita guest spending across its portfolio. The segment delivered $2.717 billion in revenue and $958 million in adjusted EBITDA for the quarter, reinforcing Comcast's ability to self-fund expansion and absorb shocks without resorting to distressed borrowing. The contrast is unambiguous. Merlin is absorbing losses and watching its equity base erode, while Comcast is scaling up, investing, and delivering double-digit growth from new projects. As Merlin's financial position weakens, its ability to invest, refinance, or defend market share narrows. Comcast's balance sheet, by comparison, enables Universal Studios Bedford to proceed with a capital commitment in the £4 to £6 billion range, targeting a 2031 opening. The imbalance between these two operators is not just a question of scale, but of financial resilience and strategic flexibility. Universal Studios Bedford is not simply another new attraction entering the UK market. It is a £4 to £6 billion development on a 476-acre site, with construction officially underway on the 12th of January 2026. The opening is scheduled for 2031. This project is the largest single capital commitment in the UK leisure sector in decades, and its timeline intersects with Merlin Entertainments' most vulnerable financial period. The sequencing of these events is critical. Merlin faces a hard refinancing deadline in November 2027, when £630 million in senior unsecured notes mature. The company must secure new funding at a time when its credit rating sits deep in junk territory and access to affordable capital is severely restricted. At the same moment, Universal Studios Bedford is progressing through its peak construction phase, with visible signs of rapid development and a clear message to the market. A major well-funded competitor is about to enter the field. The compressed window between Merlin's refinancing cliff and Universal's 2031 launch amplifies the risk. If Merlin is forced to accept punitive borrowing terms or divert cash from investment to debt service, its ability to upgrade assets or mount a credible competitive response will be limited. Unlike past periods of competition, the threat is not abstract or distant. The calendar now works against Merlin. Each year of deferred investment, each quarter of negative cash flow, narrows the group's options. The arrival of Universal Studios Bedford is timed, by happenstance or design, to coincide with Merlin's weakest point in decades. The risk is not just about market share, but about the sequence: financial constraint first, then competitive shock. Three distinct scenarios now define Merlin's path to 2027 and beyond. The first is a successful refinancing, achieved through creditor negotiation or a liability management exercise, such as an amendment, an extension, or a partial equity injection. This outcome would require Merlin's management to secure support from bondholders, likely at the cost of higher interest or dilution, but would buy time to stabilise operations. The second scenario involves a distressed exchange or formal restructuring, triggered if market access remains closed and liquidity deteriorates. In this case, creditors may accept new instruments or equity in exchange for concessions, while management works to avoid insolvency. The third possibility is an outright sale of core assets or a breakup, should refinancing options fail and Universal's competitive pressure intensify. Each scenario will leave clear signals, for example, amendments to bond terms, sudden asset disposals, or public restructuring talks. Observers should watch for these cues as the 2027 deadline approaches. Project Horizon, a £12.5 million indoor attraction approved for Alton Towers in February 2023, remains unbuilt as of April 2026. Planning records confirm the scheme received the necessary permissions, yet no construction has begun. This delay is not an isolated scheduling issue, but a direct reflection of Merlin's restricted ability to execute even modest capital projects. Trade press coverage, including Blue Loop, notes the absence of physical progress despite the project's green light more than 3 years ago. Within Merlin, the project team's work has stalled amid repeated budget reviews and capital allocation freezes. The gap between board approval and actual delivery exposes a wider paralysis, capital is being rationed, and discretionary investment is deferred. Project Horizon stands as a tangible example of how financial constraints now limit Merlin's capacity to renew its assets, reinforcing the urgency of the broader refinancing and competitive pressures already documented. Today, Merlin faces what ratings agencies call an unsustainable capital structure, £630 million due in 2027 and an operating income of minus £58 million. Universal's £4 to £6 billion project arrives as this pressure peaks. For the United Kingdom market, financial fragility, not just competition, now defines the risk. The timeline is unforgiving.